there's life things that happen, right? Or, a business went under. They were just taking a chance and it didn't work out. But then they've reestablished their credit and they're a 730 credit score. So they've been doing everything right to get past it. They're in a location that a B lender will pick them up once they've been discharged, right?
This is something I think you probably see more frequently and actually have that conversation since COVID. Like you could have had a business that was piping, like it could have been a restaurant that was absolutely crushing it.
Yep.
COVID shut you down completely.
Totally.
And you're seeing a lot of them that never recovered.
Yep.
To be honest. And you're tough because your whole life's built around it and you've signed a 10-year lease and you've got all these things these obligations. So you try to keep it going and it drives you to bankruptcy. And it's not because you're a bad operator or you're not good with your money. You got hit by an extreme unforeseen circumstance that put you in that position today.
Yep.
Thanks for tuning in to the Canadian Private Lenders Podcast, the show about starting a private lender in Canada, the mortgage industry, and the real estate industry. Your hosts are Neil Andrino and Ryan McNeil. Enjoy.
All right, everybody, welcome back. It's episode 42 of the Canadian Private Lenders Podcast with your hosts, Ryan and Neil. Neil, how's it going?
Good. Great. Just actually, I'm a little sad. I'm not going to lie to you about summer, but...
Okay. Why? Because it's now August?
It's now August, and the sun was like going down at 9:15. And
Notice
it's now
that.
about 8:45.
Yeah,
and
big change.
Like, oh no.
Yeah.
And it's also a little chillier. Like I was sitting outside, and I got to my friend's house, and I was like, I need to borrow some shorts. And then like 8:30, I was like, I'm putting my pants back on because it's getting a little cold.
You know what? I actually felt July it felt like it lasted a really long time this year.
Nice.
And it was beautiful, like crazy good weather in July this year on the East Coast. But as you know, August is the fastest month of the year. What does Taylor Swift say? August slips away?
I didn't know that, but now I do.
Yeah, now you do.
Anyways, that's not what we're talking about today. No more Taylor. Our episode today is about our private lenders for borrowers with bad credit.
Yes.
I can't read while I'm talking.
Yes, we're going to answer that question.
And I think that is a misconception. A lot of people assume
for sure.
that. I was in a lunch meeting yesterday and I'm like, so you guys just do people that can't get loans anywhere else?
Yeah, probably the most common misconception for private lenders in Canada that's what we're here for. And that's just simply not true, but we're going to go through that in more detail.
And there is a segment, I will say, of private lending that is for bad credit.
Yep.
But I think, honestly, I feel like 80% of it is not that.
Easily.
So,
100%.
But before we get into that, we have a couple articles we're going to go over.
Yeah. So I got a couple of interesting ones here, Neil, that we were just briefly chatting on. But interesting article from BMO a couple days back that mortgage arrears have yet to peak, but are unlikely to reach long-term norm. And they say, despite a gradual rise, Canadian mortgage arrears are expected to remain manageable due to economic recovery and the mortgage stress test. Initial thoughts?
So its initial thoughts are, okay, that sounds great, but I've also seen some other articles at the same time. So my honest immediate thoughts are like the banks are trying to save face, where they're trying to release like, how do I say it? Very tactful with the words that they use in their releases to be like, it's all good, because they also have a massive share price to protect. And they also don't want to cause a run where people start maybe withdrawing from their investments that they have within that bank. Yeah. So that's my take.
Yeah. Just a couple numbers to back up what BMO's saying here is that in April, the rate of arrears, I guess, fell from 0.19 to 0.18, where historical norms, I think, are around the 0.2 to 0.25 range.
Yeah.
And that was coming off a low of 0.14 in 2022. So, there's obviously nuances based on provincial splits here. Ontario, by far the lowest in Canada. British Columbia, super low too. I know. It's crazy. How does this make sense? But I think, remember we went through in a past episode and it was the small balance ones that were more likely to default?
Yeah, it was, which I guess it kind of makes sense-ish, but
maybe just the fact that there's more equity available in those areas, that if people get into trouble, there's just
tapping into endless equity.
Exactly. They sell it at a slight loss to what they bought it for maybe, but they're not going to remain in arrears or have to go through foreclosure or power sale.
There's just more places to pull money from.
Yeah, exactly. But that's interesting. But as I was reading this article,
this is the thing.
yesterday, another email comes in. Canadian banking giant hit by downgrade. This is hilarious. So this well-known, I guess, RBC analyst now downgraded BMO's stock
Mhm.
And basically it was due to what you were just saying for their provisions for credit losses.
That's all. It's like Darko called me and was like, I'm going to be downgrading you guys.
Yeah.
So if you want to put out a news article to try and save a little bit of
For
face
sure.
right now, go ahead.
I was thinking that too. Like, I thought it was hilarious just reading through this. Like, obviously the big banks are, they have many different branches in terms of what they do. And also that includes Bay Street analysts as well. But I just thought this was hilarious coming from an RBC analyst, coming from the CEO being like, let's smash BMO today. Let's take them down a few notches. Okay.
I was thinking this too. I'm like, they must chat a little bit. Like, are they in good terms?
100%.
Or is it like they're just shooting shots over each other's
No.
bows? Like, because it just can get nasty. And the
For
problem is
sure.
they can manipulate stuff so aggressively to the
Yeah.
point of like the tactful conversation of like, no, things aren't so
Yeah,
bad.
yeah.
They can also go aggressively the other way.
Totally. Analysts at that level, like in my very short cup of coffee I had on Bay Street, they would be spending time with senior management teams of all these major institutions and getting to know them and understanding and going in depth and asking those pointed questions as well before shaping their opinions.
Man, that's got to be awkward though. If you're like,
Yeah.
you go for lunch, and you're like, so I'm going to downgrade your company, which
For
is
sure.
probably going to drop your valuation by about $3 billion.
Yeah. Yeah. It's
And he's
crazy, eh?
He's like, man,
Yeah.
how about I give you $1 million
Yeah,
and
yeah.
we don't release this?
A lot of pull.
Didn't you see? So it was also on the credit delinquency and also U.S. exposure.
Okay.
So RBC is heavy on the States, and they've also bought some more banks in the States.
Okay.
And so just, I think, some concerns around what that looks like as well for them. Because, I guess we don't talk about it as much because we're not in the States, but their rates are very high. They haven't done any cuts. And it seems to be okay on the residential side because everyone has very long, like locked in terms, 10 plus years. But commercial consumes a large portion of any bank's lending portfolio.
Yeah.
And I think that's at a high risk because there's shorter terms in the States. But anyways.
Yeah, that's quite interesting. But anything else on that, Neil?
On the other side of the world, I saw this and I thought it was kind of interesting simply because of what their rates were, is Japan. Have you seen what their mortgage rates are?
No. Tell me.
Okay, so, well, first off, Japan just had their second rate hike. They had one back in September, which is the first two in 17 years.
Okay.
So they have not moved rates. And many of you may know that the GDP of Japan has been stagnant. Population's shrinking.
Sure.
Like, it's just as much of a technologically advanced country and an efficient country and also population dense. It seems to be like it's crested and almost kind of regressing.
Yep.
Their posted mortgage rate online right now, 0.27%.
What?
Yeah. I was like, this is after two rate hikes.
What sort of term?
They're doing variable, like open terms. So, and they said 75% of people go on a floating open 5-year
Wow.
mortgage. But
What was it before? They were just free?
yeah, like literally they've been floating around zero,
Crazy.
which is insanity. And they still had no GDP growth, which I thought was like craziness.
Wow.
Japan actually benefited a lot from COVID because of inflation. Inflation just forced the growth of their GDP.
Mm-hmm.
But they're now saying they're raising rates based on expectations of increased wages.
Wow.
And so they think that the cost, because people are starting to now downgrade certain things over there, and people are pulling investments from certain areas that they think are going to be impacted, predominantly real estate, impacted by the additional cost of money. But they think that the growth in wages will actually pace the additional cost of money, and it'll help to grow things overall.
Wow.
But yeah, that to me, basically, they just, in Japan, if you need to borrow money, it's free.
Crazy.
Anyways,
Why don't they just try the Canadian approach and just open the doors to mass immigration?
Japan culturally has never
Because it works so well for us.
yeah, it's working really well
Yeah.
for us. But I mean, they should probably do some or a little bit at least. But Japan is not an immigration based place.
Right.
They do not like immigration. It seems like, I don't know if it's a cultural thing or
Right.
what it is. But they're very much like they run within their country. Like when I visited recently,
Yeah.
and yeah, you just don't see a ton of foreigners unless they're like literally tourists. And even that, like, things had limitations on the amount of tourists that could be in a place or how many could go through in a certain time frame.
Right.
So I think there's almost like a kind of a happiness in that they found like this like balance. But anyways, I was most blown away as I was reading it, and it was like posted rate 0.27%. I was like, in my head immediately, I was like, is there a way to borrow money from Japan and bring it to Canada?
Yeah. Probably still be cheaper than whatever tariffs and taxes you got to pay on that.
Yeah, 100%.
Yeah.
But
All right, let's get into it, Neil.
Yeah.
So, are private lenders for borrowers with bad credit?
Yes.
And no. So let's go through that. So, I mean, yeah, occasionally private lenders do loan to clients who have got damaged credit in their past, maybe a past bankruptcy that's now fallen off their credit bureau, a consumer proposal. Maybe they've got overextended credit or had some sort of marital breakdown. And we'll go through those in more detail here. But the vast majority of institutionalized private lenders and mix, they're lending to clients who have good to great credit.
Yep.
Right. And that is a stigma that has been challenging for the industry to get past in the past several years. It's come a long way, I'd say, in the last 5 to 10 years, where there's this greater need for alternative lending. And therefore, naturally, people who have solid credit but are maybe self-employed are requiring to go to. Right.
When do you go from a private lender to an alternative?
So a private lender to an alternative, I'll just speak in terms of like a B lender, like say a home trust or Optimum or Equitable Bank. That is typically a scenario where I'd say 2 major scenarios. It's always going to be an urban center because B lenders will only lend in urban centers, whereas private lenders typically have a little bit more flexibility geographically. At least that's the way we operate.
Yeah.
I'd say the 2 most common scenarios, one would be, the credit's not quite good enough to go to a B lender. They might require a 6 or a 620 credit score.
Yeah.
Maybe it's a 580. So you need another 6 months or a year before you can graduate to a B lender.
Yeah.
The second would be income or employment, lack of a track record.
But when does the lender get qualified? Like when does a lender become like, so right now we're a private, what would constitute us as an alternative?
Great question.
Is it?
I think anybody could do it realistically. They're not all banks, right?
That's what I mean.
So anybody could do it, I think.
Because there's private alternative lenders.
Yeah. Because some private lenders play in the B space too, right?
Yeah.
And they compete with the home trusts out there. So
that just popped in my head and I'm like, what?
Yeah. No, I don't think there's any regulation around that other than, abiding by the OSFI rules.
I kind of say this from a place of like being a part of it now. I hate the stigma a little bit. I'll be honest with you, it does get me. I find like I get triggered a little bit. I'm trying not to, but I have friends that are in banking and they love to throw shade. They're just like, why don't you ask Neil? 29.99%. I'm like, all right, that's funny. And
that's not what we...
Which is not what we charge. And I don't think, yeah, exactly. I think that's what the mob charges.
Yeah.
And they're just like, and it's always in situations where it's like someone's having a really big issue and they're like, oh, Neil can do it for you at this crazy. And I'm like, well, I actually probably wouldn't lend to you. And it also would be a lot more reasonable than that. But, and then I met a guy a couple days ago. I don't think he'll ever listen to this, but we were kind of running along chatting and we were talking like, what do we do? And he's in real estate. So I was like, oh yeah, like I was in real estate. And then right now I'm working with my colleagues on this private lending thing. And he's like, oh, it's like you do predatory loans. That was the first like thing that came out of his mouth. And I couldn't help but feel like I had to like defend myself and justify what we do. And cause he comes from a big time real estate family. And he was like, oh, I'm just joking.
Yeah.
But I was like, damn, that is the first, like, I was like, you took a millisecond to pop that out. So like, that is what's going through your head when you hear it. So anyways, it's a stigma that's weird. And I'm like, it'd be interesting to be able to separate that even like in this situation where we're talking about bad credit borrowers, like there's like the payday loan sort of situation.
Yes,
like,
that's what I was just going to bring up.
Yeah. Those type of banks. And there are ones again that are out there that are designed for people that are in credit delinquency situations, but that's like a whole separate category. And that's an extremely high risk. We'll say, I guess, higher return for them, but they charge like those guys, those lenders have literally limits on what they can charge because they're maxing out the rates. Like they're like literally like 30%, 40% rates, and they're taking huge fees and it's all like super short term. But that's a whole nother industry. I'm like, that's why I'm like, is there a way? How do you get from private to alternative? Because it'd be nice to like.
I hear what you're saying.
Yeah.
Yeah. My first thought is that you need to get new friends. No, I mean, I've faced that same feedback from several people too, or just maybe unaware or uneducated on the space, right? And I see that as an opportunity to educate, right? That's a big part of the industry. But to your point, payday lenders, Fairstones, those players out there, which Home Trust owns, by the way, or they're owned by the same owner, but we'll get into that. Or credit cards for that matter, which a lot of people end up racking up debt.
Yeah,
they're charging twice as much at least.
Actually, yeah, what the hell?
That we are, right? And that's the bank getting most of that credit card debt at 29 or 25% or whatever they charge, right?
I'm going to start saying that.
Yeah. So there's your rebuttal.
When they throw shade of like, you guys offer products that are infinitely more expensive.
Yeah.
Also, my unsecured line of credit with any of these banks right now is like 10.5%.
Totally.
I'm like,
it's not far off at all.
I'm like, relax.
Exactly. Yeah. So there's a lot of ammo to go back with there.
Anyways,
but
just got a little emotional. I was getting all fired up.
I like it. So as mentioned, yes, the majority of clients with institutionalized private lenders have good to great credit.
Yep.
So, but there is some examples where credit is poor or average. Okay. So, and I mentioned off the top, past bankruptcy. Okay. So bankruptcy stays on your bureau for a long time.
Yep.
It typically takes, I think, 2 to 3 years to work through the bankruptcy, or maybe a little bit less than that. I think it's maybe 2 years. But then after it's done, it stays on, after you've been discharged, it stays on your bureau for another 6 years. So that's on there.
So discharge is once it's like,
it's been settled with the creditors.
So you go bankrupt and then you get settled, which could take, what does settled mean? Like you've been paid back?
Well, it's not necessarily paid back because they come to agreements with all the creditors on there, right? So it might not be the actual full amount you owed. It might be this person can allocate this much to your loan, and they're going through bankruptcy. And so once those payments are done, whether that, I'm not sure exactly how long that is, but I think it's somewhere 1 to 3 years time frame.
Yeah.
After that's been done, it still stays on the bureau for 6 years. So all mortgage lenders are going to see that, basically.
Wow.
And then if you do it twice, that doubles, right? So it's like...
it stays on your bureau for even longer?
Yeah, exactly. For a second bankruptcy, it's like 14 years on the bureau.
That's crazy.
Yeah, it's wild. So that could be one scenario, right? We, speaking from our perspective and our history, very choosy on which loans we would participate in here, right? Some clients do, there's life things that happen, right? Or, a business went under. They were just taking a chance and it didn't work out. But then they've reestablished their credit and they're a 730 credit score. So they've been doing everything right to get past it. And, they're in a location that a B lender will pick them up once they've been discharged, right?
This is something I think you probably see more frequently and actually have that conversation since COVID. COVID was something that's like,
right.
Nobody could have predicted that. Like you could have had a business that was piping, like it could have been a restaurant that was absolutely crushing it.
Yep.
COVID shut you down completely.
Totally.
And you're seeing a lot of them that never recovered.
Yep.
To be honest. And you're tough because your whole life's built around it. And you've signed a 10-year lease and you've got all these things these obligations. You try to keep it going and it drives you to bankruptcy. And it's not because you're a bad operator or you're not good with your money. You got hit by an extreme unforeseen circumstance that put you in that position today.
Yep. Absolutely. So 1A, bankruptcy, 1B, very similarly, consumer proposal. So consumer proposals stay on the bureau for 3 years after making the final payment or 6 years after signing the proposal, whichever comes sooner.
And so that's when you pay everything back.
I think so. I actually don't know all the details. We should get like an insolvency trustee on here to walk through it. I don't know the details of how that works exactly. Yeah.
He came in there.
Absolutely.
Yeah. Okay.
So these clients would only be considered by a private lender once they've reestablished their credit for the most part. Some private lenders might operate differently, but this is how I've seen most operate. And if they have a marketable property, right? An area where multiple lenders and multiple exit strategy avenues are going to be available to that client.
Yep.
Right? Because the delinquency's been there in the past. As you know, history tends to repeat itself, right? Or can repeat itself. So I think that kind of covers that. Anything else on that piece?
Totally. I'm going to share a personal experience. And it's funny. My buddies are like, oh my God, you have that on your credit bureau? So I've had like perfect credit my entire life. I'm just going to pipe off here.
Yeah.
And then I had opened a Home Depot line of credit for 10 grand. And I found it annoying to manage. So it never got utilized. I don't know if my mom's listening to this, but my mom was in Home Depot buying some stuff for her house.
Yeah.
And I was like, yeah, no problem. Like, use my account because it gives you a discount. So she did. But in that process, it ended up that her purchase ended up on my Home Depot line of credit.
Mm-hmm.
It was $37. And I haven't looked at this thing in 3 years. Okay. So I left it on there, not paying any attention. Home Depot starts calling me with a 1-800 number after it's been sitting on this line of credit for 3 months or 4 months or whatever. Like it's past due now. But I'm not, man, I get probably 15 1-800 numbers a day.
Mm-hmm.
So I'm not picking them up. I'm busy as hell with work, whatever. Sure enough, the month turns over. I missed the payment on the line of credit, the minimum thing for like $2. That went on my credit bureau, and it demolishes you. Like I was like an 830 to like 650. Like it just obliterated me.
Yeah.
And it actually now still has an impact. It's been like 3 years since that happened, or 4 years. And like, I don't know if you guys have ever pulled, I had never pulled a credit report or any of this shit before in my life. This happened. And like, the only reason I figured it out is because I was doing a mortgage at the time. My lender was like, yo, you're missing payments. Like, what the is going on?
Yeah.
And I'm like, oh my God. And I opened it and it was literally like $38. I was like, I'm going to get sunk on $38. Pay off the thing. I called Home Depot. They wouldn't like redact it. Like, well, you missed it. I'm like,
Yeah.
are you joking right now? Anyways, it actually impacted my loans moving forward. And the thing that blows my mind now is I pull the report once in a while, and I don't know, like they'll probably all look kind of the same, but like it basically has every month and it gives you like a green check if everything was good. And so literally it's just like 5 years of green checks, the red X, and then 3 years of green checks. And I'm still like, it still has a damper. Like I don't think I can break like 800 now until it's like, I think it's 3 years or 5 years until it's, I think it's 5 years until it's fully off of that sheet.
Yeah.
Like
crazy, eh?
Psycho.
Yeah. And you're right, Neil. I think that will impact with bank loans. There's no way around it. If that credit falls below a certain level, they don't really care. But the good thing that a private lender can do in that scenario,
they can have that conversation.
Exactly. They can listen to the story.
$40 Home Depot
for sure. Right. And you can actually kind of dive into that. And we see it with phone bills all the time, right?
Man.
Some sort of argument between, when the bill was due or whatever the amount was or whatever. Right. So
craziness.
All right, number 2 here. Why don't you go through this, Neil? And you've probably, people in your network probably have dealt with this before, just in general with real estate investors and, managing multiple properties at once.
Yeah, 100%. I've been in this position multiple times. Overextended credit and high utilization. This is a very common scenario, I would say, for people in the real estate world, simply because typically, especially if you're in a project, you're not getting consistent revenue. It's typically the whole concept is you get a big payout at the end, and then you go into these projects. So when it gets down to like the very end of the wire, and I'm talking for smaller, like duplex, triplex people to even the guys building the $100 million buildings, they are tapping everything that they have to get these things across the line to finish it out and get their construction mortgage taken off. And in that process, when you have high utilization, so if you have been allocated, let's say, $100,000 between your 2 credit cards, your line of credit, and some other loan, if that is filled up, so if the line of credit is fully utilized, or you've pulled all the money off of that, there's full amounts on your credit cards, and that loan is at full capacity, the bank looks at it as let's say a 95% utilization, that can beat down your credit score. And it can look bad to obviously to some lenders. But again, I think to what we're going to say here is again, with the story and understanding of what's going on and how it can be managed, it can be paid down. I will say in my experience, a lot of times when I'm going to buy a property, like if I have money on my line of credit, they'll just ask me to wipe it off.
Yep.
Which can be good in some ways. I think I always find that one funny because I'm like, it's a line of credit.
Yeah.
Like I'll wipe it off, but like literally the day after closing, I still have.
It's a game.
It is a bit of a game, but you mentioned here often clients that have overextended credit or end up getting in high utilization positions have stellar repayment histories.
Yep.
But they have credit lines that they max out having multiple projects on the go. This is also for pretty much, I don't say any business owner, but like if you run a construction company, when you start all your projects, you are outlaying so much to get them going.
Yep.
That you typically like, and home builders, like you're outlaying everything to get these projects to the point of completion. And then you get this huge, again, you get this single influx of cash. Same with like restaurants and everything. Like when they need supplies, they have to light it up and like they might be preparing for an event. So it's a very normal thing to have this capacitive type utilization. But again, high utilization gets looked at poorly by the credit bureaus, which ultimately means for like a lot of, we'll say A lenders, it can be frowned upon as well.
Exactly. And a lot of people probably don't realize this. I know I didn't realize before coming into the industry that even if you have perfect payment rehistory, but you're maxed out on all your trade lines, it's still negatively impacting your score.
Yeah. And again, that's where I think a lot of business people get beat up.
Yep.
A lot of business people, because they have perfect repayment. They understand, they're like, yeah, we get this. It's a business. You guys have agreed to a $500 a month payment. I have $50,000 available to me that I need to utilize to keep this thing running. So we got a good thing going here. But for some reason, the way the credit bureau handles it is they're like, Well, and I get why. I think there's almost like there should be like a consumer credit and a business credit.
Right.
Do you know what I mean?
I hear you. But then we might not get as much business. So, and just on that note, like this is probably the most common profile for damaged credit that we would, or average credit, maybe I'll say, that we would take on, because we look at that and we say they never miss a payment.
Yeah.
Right. They're not going to miss with us. They're not going to start now. Right. Like, it's just, who cares if their score is 650? That might be better than someone with a 725 with 3 trade lines and they just happen to make their payments. Right. So, it's almost showing more of a track record in some ways.
They have an understanding of how debt works and how to utilize it for their business.
Yeah, exactly.
I guess it makes sense. Again, if you're looking at personal, if someone's got maxed out everything, that's where it gets a little concerning.
For sure.
If someone's coming in for a personal loan and they're like, my credit card's full, my line of credit's full, and I want a fixed income. It's like, okay, well then how in the world are these going to get cleared? Yeah,
credit cards being maxed out might be a different scenario there. More so, using line of credits to fund projects, fund renovations, buy assets, right?
Yeah.
So awesome. Okay, third and final one here. Another very common one we see: marital breakdowns. So this is a challenging one, right? But a very common example of what type of client a private lender would see. Obviously, can be due to a multitude of factors, but specifically, it would be joint debts where both partners are named as borrowers, right? This could be credit cards that they're both named on, lines of credit, mortgages, of course. Okay. Typically, during a marital breakdown, you have zero influence or control over the ex-partner for, in most scenarios, and other factors could be at play. So sometimes we see this as a scenario where a private lender can kind of step in, and maybe you've got, a separation agreement in place, but a jointly owned property, and one spouse wants to, as part of that separation agreement, buy the other spouse out, right? So this could be a scenario where you go to a private lender, refinance in one person's name, pay out the ex-spouse, and then you can kind of go ahead with your separation agreement from there.
How does it work for the other stuff? Like, you can have a joint credit card?
I think so. Could be wrong on that.
Okay. Well, no, you can have joint bank accounts and stuff.
Yeah, you must be able to.
Why the bank would say, like, we got two of you now.
Exactly.
Like, this is extra.
Yeah, for sure.
So what? I wonder if in that situation, can you call the bank and be like, we're going through a divorce? Like, the bank's not going to give a shit.
Probably not. Nope.
But
sort it out.
Which is crazy, because you're right. So you get in a breakup, your partner, you guys have this joint line of credit.
Yep.
And you open it the next day, like, they just maxed it out.
Yep.
And if you don't pay it, your credit's going to get bounced as well.
Yeah. See it all the time.
Really?
Yeah. Absolutely.
Whoa.
Yeah.
That's damn.
Yeah.
Okay.
Divorce sucks.
Yeah, man. It's not just like the emotional trauma. There's also all the financial damages that go in. I've heard it's insanity. I never. Wow. Okay. So I mean, I've had some friends that have gotten separated that have all of this, but they've been very cordial, and I feel like they've kept it all paid down, because they're like, look, we don't get along, but we don't need to try and ruin each other's lives.
Exactly. It's mutually beneficial to not sink each other's credit scores, because you're doing it to yourself too.
But I could see where some situations get so heated that you're like, you know what? I'm going to tank my credit score just to tank your credit score.
100%. It definitely happens.
Wow. Yeah. So, I mean, I guess if you call us early enough, we can pay everything out for you. You can get your names off of things.
For sure.
And then move on. It might be a little bit.
Get that separation agreement signed ASAP if you're going through it.
Yeah.
Yeah. Wow. That's a big thing for sure. Anything else we missed, Neil?
No, I don't think so. I hope you all, I mean, I think everyone that listens to this knows what we offer and what tool and service we are, but just stop throwing shade, man. I can't handle it.
Spread the good word here, right? Like, we need some help in educating people. We're a tool to get from point A to point B.
Private and predatory are two different things.
Totally.
Thanks for listening, guys.
Thanks.
Hey guys, it's Neil Andrino, your co-host and your co-founder at Keystone Capital and Director of Investor Relations. I'm also a real estate agent, real estate investor, and business owner.
And your co-host here, Ryan McNeil. I'm the co-founder and president of Keystone Capital Group. Keystone Capital Group is licensed under the Mortgage Regulations Act of Nova Scotia, license number 3000549, and through FCMB, license number 88799. And keep in mind, the views of this podcast are for informational purposes only and is not financial advice.